It's almost here. The bull expansion moment that brings Bitcoin price and volatility screaming back to 2021 levels. I'm not talking about the spot ETF launch.
These Bitcoin ETFs,
Bitcoin ETF.
The long-awaited spot Bitcoin ETFs began today.
Although that certainly brought with it some excitement in recent months, it was only a small taste of what's in store for the second half of this year. I'm talking about the halving event, coming up this April. That's when Bitcoin's rate of new supply gets cut in half. Now you may remember me discussing in the last video that due to the supply and demand dynamics that come into play after the halving, that this is historically the point in time when price begins its ascent towards new all-time highs. But as we also discussed in the last video, the returns after each halving cycle have been getting smaller and smaller. This means simply buying and holding Bitcoin now won't give you the life-changing returns others experienced during previous bull runs. The upside is now capped. Now if you're like the majority of crypto traders, this fact probably makes you feel like you have to hurry down the risk curve and ape into whatever the hot new narrative or meme token of the day is. But as many have learned the hard way, the majority of altcoins are indistinguishable from gambling, as the ability to adequately hedge yourself and your risk exposure if you own them is virtually non-existent for most. It's a game of musical chairs, and the odds are if you're too far down the risk curve when the music stops, you'll be the one left holding your worthless bags without a seat. Just ask the owners of Terra Luna, which saw over $40 billion of paper value wiped out in a single day. Or the owners of FTT token, which collapsed along with FTX in 2022 and erased billions of dollars in the process. Or any of the other countless rug pull victims we see on a nearly daily basis. If you've been around in crypto long enough, you've heard the horror stories. Or you may have even been a victim of a few scams yourself. This is because trading altcoins is a lot like navigating your way through a minefield, and the odds of you surviving, let alone exiting with any wealth, are extremely low. This is why today, I'm going to teach you how using options in 2024 will help you not only pace the gains of holding spot Bitcoin, but also help you more effectively manage your risk. So before you go ahead and deposit your last $500 into the latest meme token launch and pray you can hit 1000x before it rug pulls, hear me out, and learn how the Bitcoin options market will offer you the greatest opportunity for outsized gains into and after the halving. Less risk, more gains. I know it sounds scary and intimidating if you've never traded options before, having to try and learn about things like Greek letters and all of that other jargon that options nerds on Twitter love to freak out about. But today I've got you covered. I'm going to show you how to perfectly time your options entries and show you how to profit off the wave of upside volatility that looks primed to hit this spring, without overcomplicating it. But before we get into nailing this bull expansion moment, we first have to understand our current positioning on the Bitcoin options rainbow chart, which we introduced in the first video. And as we see here, despite all of the early 2024 fireworks, we're still in the thick of the blue phase, albeit nearing the tail end. So by the end of this video, you'll understand how to trade the remainder of this blue phase and the beginning of the green, but before we do, you'll have to first better understand the blue phase and all of its nuances. So let's journey back to the beginning of our current blue phase to refresh your memory and give you some pointers for next time. We officially entered our current low volatility blue phase all the way back in June 2022. If you remember, that was a few weeks after the infamous implosion of Terra Luna, which sparked a domino effect of over-leveraged firms collapsing such as 3 Hours Capital, Celsius, BlockFi, and eventually FTX. Retail and institutions alike were liquidated en masse, and all of this culminated in Bitcoin plummeting to sub $20,000 for the first time since 2020. What followed next was a prolonged era of mind-numbingly low volatility as the market suddenly found itself out of active participants. As a result, following that summer's crash, price mostly stagnated and bounced around a sideways pattern for the remainder of 2022. Now remember, when trading options, Bitcoin's volatility level determines what strategies we should use to extract profits from the market. Looking at the BVOL, BitMEX's historical Bitcoin volatility index below, we can clearly identify the summer of 2022 as the moment in time when we entered the low volatility blue phase. As we see here, after summer 2022's crash, BVOL, or the amount of realized volatility we were experiencing, collapsed from a score of 82 to 18. And in the year and a half since, Bitcoin hasn't come close to reconquering its average volatility range of 50 to 100. Even throughout 2023, when Bitcoin nearly tripled off the lows of 2022, volatility didn't follow with it. It was just a relentless, slow grind up, with BVOL never breaching past 30. This slow grind up created the perfect conditions to profit off options by selling out of the money calls and puts each time volatility made a mini rally and options premium spiked, as the moves were never followed through in any dramatic fashion. A perfect example of profiting by selling overheated options was witnessed in the past month during the pre-ETF hype phase. Though realized volatility levels were still very low, there was a demand for exposure to out-of-the-money BTC calls, which caused a large discrepancy between implied volatility levels, or the market's expectation of future volatility, and the realized volatility levels we track on the BVOL chart. This was because many people evidently weren't aware that we were still in the blue phase and didn't want to miss out on any potential pumps. This FOMO demand for call options meant that calls with strikes above $50,000 that expired in early January could be shorted by savvy players for a few thousands of dollars apiece at the peak. And all of that premium turned into profits for option sellers when they expired worthless after the ETF came and went without a major price breakout. The people who bought up those out-of-the-money options got burned. It's because they weren't aware of the larger, low volatility regime we still find ourselves in. Again, historically speaking, you don't want to be an options buyer until BVOL is consistently trending above a score of 30, not 15. But fortunately, right on the cusp of this changing tide in volatility is where we currently find ourselves. Meaning that the return to ideal options buying conditions is coming, it's just not here yet. So let's revisit that BVOL chart again. What we see here is a chart that looks primed to break out back into its average range after a long period of compression well below the mean. Think of the Bitcoin volatility suppression we've seen since 2022 like a beach ball underwater. It can be suppressed for so long before it shoots back up and re-enters its natural state. And when we refer back to our options rainbow chart, we see it's also telling us that a high volatility breakout is a matter of when, not if. Add to this the narrative factors around things like the ETF and the supply-demand shift that will take place after the halving, and we have all of the ingredients necessary for a highly volatile 2024. And here's how you can capitalize on it. As we discussed in the first video, the crucial signal we're waiting on to confirm that Bitcoin is ready to enter a full-blown, high-volatility bull market is a period of consolidation above 50,000, with BVOL trending above 30. Now until that happens, all rips in volatility are still for selling. And this doesn't just mean a quick wick above 50,000 that soon reverses, but rather a lengthy period of acceptance above that level, which will set the foundation it needs to accelerate to all-time highs later in the year. That would be similar to the pattern of consolidation we saw in the fall of 2020 in the $12,000 to $14,000 region when BVOL started trending up, just before Bitcoin's major breakout to new all-time highs that December. And though in 2020 this happened 6 months or so after the halving, you shouldn't rule out the possibility that the market has adapted, and as such, this key consolidation period could happen sooner than anticipated this time around. Regardless of when it takes place, however, such a consolidation period would be when you want to get long volatility exposure by way of long-dated call options. This is because although implied volatility levels at this point will be higher than they were throughout 2023, due to the lengthy period of volatility compression we've been through in recent years, they won't be properly priced for a parabolic Bitcoin run that quote-unquote nobody sees coming. This is because option markets price themselves based on where price has been recently, not necessarily where it's going in the future. And more often than not, after long lull periods, they miss the mark and are wrong in their estimation of price's ability to accelerate rapidly. This error in the options market's pricing will be your window of opportunity. And here's how we trade it. So let's say we see that $50,000 consolidation pattern happen and you decide you want a full exposure to Bitcoin's price through the end of the year, but don't have enough funds available to buy a full Bitcoin, and also don't want to waste your funds trading futures only to become BlackRock's liquidation engine's next victim. What you can do is go to CoinCall, using the link in this video description, and buy December 2024 $70,000 call contracts, currently trading for around $4,500 each. Now remember, this cost will likely fluctuate rapidly between now and the time we see the Bitcoin consolidate above $50,000, but for example purposes, let's continue. Purchasing this call option reserves you the right to purchase a full Bitcoin at a price of $70,000 until the end of this year. Again, this $4,500 of premium is the cost you would pay to have a full Bitcoin's worth of exposure above $70,000 through the end of 2024. This premium cost of the contract will fluctuate wildly depending on what price does in the near term, but the most important thing to remember is it cannot be auto-liquidated. Bitcoin could crash to zero for all we care, and you could lose no more than the amount of premium you pay on this contract. Your maximum gains, meanwhile, will be unlimited. So if Bitcoin ends the year being worth over $100,000, that $4,500 of premium you pay would balloon to be worth over $30,000 per contract, a gain of over 4x each, and this would multiply as Bitcoin went higher. Another advantage of buying these longer dated contracts is they give you plenty of time for your trade to play out. The disadvantage is that time you'll be buying comes at a cost. It's what's known as theta, one of the Greeks, and it measures the time value of options. Without overcomplicating it too much, this means that the more time to expiration your option has, the more risk premium it will command, and vice versa for shorter dated options. Now fortunately, options offer us the opportunity to hedge and protect our risks. A way you can do this and offset the time decay associated with your December contract and effectively lower your cost basis would be to sell shorter dated contracts against it. This creates what's known as a call spread. It's basically buying one option, being long it, and shorting another, and collecting the premium off of it. For example, you could sell the June 2024 $70,000 call contracts, which currently have a premium of roughly $1,500. You can sell that against your December call contract that doesn't expire until 6 months later. This means that you would get to keep all $1,500 of that June premium, as well as your $70,000 call, which doesn't expire until December, effectively lowering your cost basis from $4,500 per to just $3,000 per if the June contract expires worthless. This allows you to keep your upside exposure through the end of the year for just a fraction of the cost. Now, if price were to break out earlier than expected, and the June calls you sold be worth more than the $1,500 you sold them for, the gains on your December call contract would offset it, due to the spike in implied volatility and theta values which would follow with it. Another advantage of options trading is you also don't have to sell the same number of contracts or strike prices as you buy if you want to increase your upside potential. For example, you could buy 2 or more December calls for every single June call sold, or sell deeper out of the money shorter dated calls for less upfront premium but more potential upside. An alternative way to structure this, for example, would be to sell $80,000 June calls instead of the $70,000 ones. There you would collect $900 of premium rather than $1,500 of premium. And though this is a change of only $600 upfront, it could leave you with over $9,000 more in potential profit per contract should your trade play out and Bitcoin reach new all-time highs in 2024. This is because options are, as their name implies, full of options and opportunity. Now this is just a small glimpse into the infinite number of ways you can use them to strategically place your trades and maximize your upside in 2024, without going into the minefield of rug pulls that are alts. So stay tuned and subscribe below if you haven't already. And be sure to watch our next video, where we'll continue to unpack options market secrets and strategies. I'm JJ, and thanks for tuning in.